Simon Property Group a 45 billion market cap company with dividend yield of 5%. This REIT had a few bad years in terms of stock price, and year to date Simon Property Group is also down 17%. And how about the dividends? Are they sustainable in the future? In this video I will show you everything you need to know about Simon Property Group. I will show you what Simon Property does, and I will show you my fundamental analysis to see if SPG is a buy or not. I'm very excited to see what you guys think about Simon Property Group, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stock at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, what does Simon Property Group do? Simon Property Group is a real estate investment trust engaged in the ownership of shopping, dining, entertainment and mixed-use destinations and a S&P 100 company. The property across North America, Europe and Asia provide community gathering places for millions of people every day and generate billions in annual sales. So, the first thing I want to highlight is that Simon Property had a bad year during the lockdowns in 2020 and in 2021. Since they are heavily focusing on shopping malls, the company was hit very hard. This means they cut the dividends and the stock price went down a lot. More on that later in this video. In this sheet we see the data of 2020 and 2021 full year. Consolidated revenue is up and the funds from operations is also up since 2020. If we focus on the bottom of the sheet, we see that the total numbers of properties owned in the US is down from 203 to 199. The total number of international properties owned is up from 31 to 33. This is something to keep an eye on. More and more stores are selling online and the shopping malls are having a hard time competing with the online sales. This could be a potential danger. So, now that we know more about what Simon Property Group does, it's time to check the historical stock price performance. So, if you had invested $100 back in 2016, it would be worth roughly $160 in 2021, compared to the $166 return with the equity REIT index. The S&P 500 index got a $233 return. So with owning Simon Property Group stock, you didn't make more profit in terms of stock price than just $16 in 5 to 6 years. Not a great deal in my opinion. If we check the 5-year chart, we see that Simon Property is down roughly 21%. The stock went down in 2019 and when the Roni virus hit in 2020, the stock went down even further. It hasn't recovered since then. But if we check the 1-year chart, we see that the stock is up roughly 15%, which is a nice thing. On the other hand, when we check the year-to-date chart, we see that Simon Property is down 70% again. So this stock went up and down a lot lately. The S&P 500 is only down 5% year-to-date compared to the 17% of SPG. To me, it feels that you are better off with owning a simple S&P 500 ETF in terms of stock price. The next thing I want to check are the fundamentals of this company. Maybe the owned malls are decreasing and the stock price is performing very bad, but it could be the case that this stock is performing great in terms of other fundamentals. So, Simon Property is a 45 billion market cap company with an enterprise value of 70 billion, which is quite the difference. The current PE ratio is at 20, which is fine by me, but please note that REITs are having a lower PE ratio in general, so you might want to see this number a bit lower. The forward PE ratio is sitting at 25. The other metrics aren't looking that great, so this could be a sign that this is not a stock you want to own, but let's continue. Simon Property has an operating margin of 47% and a profit margin of almost 44%. This looks really nice, but again, REITs have a higher profit margin in general, so it seems to be at market average. Return on assets is very low, at 4.4%, but return on equity is sitting at 63%, which is quite high. The 12 trailing month revenue is sitting at 5.11 billion, and Simon Property has a quarterly revenue year-over-year growth of 17.3%, which is quite nice. But please keep in mind that they had suffered a lot during the lockdowns, so this number could be a bit diluted. If we check the revenue per quarter since 2010, we see that it went up most of the time. and in 2020 it went down a lot. Since 2021 the revenue is increasing again, but it is on the same level as it was in 2015, so this could be something to worry about. A really important thing is the net income. It's increasing in big amounts again and is almost at the all-time high levels again. So they don't have the same revenue as pre-COVID, but the net income is almost there. It's the same story with the earnings per share. They used to increase every year, but since 2019 it decreased a lot. In the most recent quarters the EPS is increasing again, which is a nice thing. If we check the balance sheet, we see that Simon Property has a total cash of $533 million. The debt is almost at $26 billion. To me, their debt is way too high. Companies use their debt to grow the business, but with the debt at these levels, I think you are in big danger with so little cash. If we check the cash flow statement, we see that the operating cash flow is at $3.6 billion, and the leverage-free cash flow is sitting at $1.69 billion. It's really important for a company to have an increasing free cash flow, because free cash flow is used to pay down debt, buy back shares, do acquisitions, pay dividends and all other kind of things that led to increasing the value of the business for the shareholder. Earlier in this video we saw that the stock price wasn't performing that great in the past couple of years, meaning all the profit must come from the dividends for you as an investor. If we check the cash dividends paid, we see that it's increasing in 2021 versus 2020, but not from increasing the dividends, but from increasing the shares outstanding. This is something to keep an eye on, because when they don't have enough cash to pay dividends, debt is already at a really high level, stock price isn't performing that great, you as an investor have a big problem, because there will be a huge sell-off. So, if we check the shares outstanding, we see that they are increasing in the last couple of quarters, as I just told you. This means the company has to pay more dividends because there are more shares in the market and not because of increasing the dividends itself. To me, this is a bad thing. So, since we're talking about dividends anyway, Simon Property pays a 4.96% dividend yield at an annual payout of $7.5 a share. The current payout ratio is sitting at 109% and the 5-year growth rate is sitting at 2.9%. They grew the dividends for 1 year in a row, and this is because the dividend cut in 2020 during the lockdown periods. If we check the dividend history, we see that in 2020 they decreased the dividends from $2.1 a share to $1.3 a share. In 2021 they increased the dividends, but just at the same level back in 2016. In 2020 there was no increase in dividends yet so far, but maybe it will come later this year. I think Simon Property is having a hard time beating the market and also to maintain the dividends from here. Debt is at a really high level, so I think it's good to compare them to some other companies. In this case, Realty Income, Kimco Realty, Regency Centers, Federal Realty and National Retail Properties. Simon Property has the biggest market cap and only Realty Income is near in terms of market cap. If we check the return of the stock price, we see that all the other competitors had a 1-month return of 8 to 10%, except for Simon Property, which is nearly flat. Year to date, Simon Property also performed worse versus the competitors. A really important thing for a lot of people are dividends, especially with owning REITs. It has to be said that right now, Simon Property has the highest dividend yield. If we check the dividend growth, I think it's similar to each other. It isn't looking that great, to be honest, almost flat at every competitor. But the consecutive years of dividend growth is with Realty Income, RRT and National Retail a lot higher versus Simon Property. So these companies were able to increase the dividends even during bad times. If we check the revenue growth, we see that all competitors except for National Realty have a higher year-over-year growth versus Simon Property. And if we check the forward revenue growth, it doesn't look good either for Simon Property, because every competitor is expected to grow in the future, but only Simon Property isn't. A good thing is that Simon Property has the highest margin and also the highest return on equity, so that's really nice. They even have the highest return on assets, but since this is very low with all the competitors, I'm not sure this is significant. The last thing I want to highlight is that a lot of competitors are having the same problems with debt as Simon Property. So whenever you decide to analyze a competitor, please check their debt and free cash flow, because this is really important. So, My conclusion is that Simon Property isn't a great stock to own right now. The first thing you want to think about is the industry they focus on, which are shopping malls and retail stores. With the more and more increasing e-commerce sales, you want to pay close attention to the revenue and acquisitions. Next to that, we saw that the stock price isn't doing anything good over the past years. You could easily beat Simon Property with owning a simple S&P 500 ETF in terms of stock price. The fundamentals of this company aren't that great either. The PE ratio is okay, profit margin is really nice, but the total amount of debt, free cash flow and dividends are not that safe. So this is something to keep an eye on. For me, Simon Property is a sell. I think there are better companies to own right now in terms of growth and in terms of dividends. I really don't like the fundamentals of this company, to be honest. The dividend yield may look nice, but I'm not sure if they can maintain this in the future. So for now, I think there are better deals in the market. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.